There is a legal contract that can pay you when a government breaks down, defaults, or simply stops paying. Most people never hear about it, but during major crises, it has turned the right position into a fortune. It is called a sovereign credit default swap. Here is the simple version. A credit default swap is basically insurance, but instead of insuring your car or your house, you are insuring against the possibility that a country fails to meet its obligations. You pay a premium, and if the government blows up its finances, the contract can pay out. When Greece unraveled in 2012, investors holding CDS protection on Greek debt saw massive gains. During Argentina's debt crises, the same tool rewarded anyone positioned for default. While most people watched their portfolios bleed, a small group had a contract built for that exact moment. Now the part most people miss. You do not need to own a single bond to buy protection. That means you can take a position on a country's financial survival without lending it $1. That is a naked credit default swap, and it is controversial because it turns sovereign risk into something you can trade directly. Regular investors rarely touch these because they trade over the counter between big institutions. But knowing they exist changes how you see safe government debt. Countries are not invincible, promises are not guarantees, and somewhere the market is always putting a price on the next collapse before the headlines arrive.